So the Fed completely pulled the rug out from under the market. I'm not talking about the 75 basis point rate hike. For those of you following this channel, you guys know that I've been saying there's no alternative but a 75 basis point rate hike. What we were looking for was Jerome Powell's testimony on future rate hikes, what the terminal rate will be. We were hoping that he would be a little bit more definitive. And I was betting that there was a chance that he would because of the treasury liquidity, a problem that we've discussed time and time again on this video, on this channel. I will go ahead and link the video here once again, talking about the issues with treasury liquidity. But I thought that he would want to at least restore some semblance of normalcy back to the treasury markets, and him being vague on future rate hikes and even being more aggressive on future rate hikes would not bode well for treasury liquidity. And once again, the treasury market looks absolutely broken. Here is the 2-year treasury. We have not seen these rates going back to 2007. So I'm going to be telling you about what the Fed actually did during the last FOMC meeting, what they actually said, what that means for the markets, what that means for treasuries, and what that means for stocks. Once again, when there are severe dislocations in the market, just how the bond market is broken now, that tends to present opportunities for us in the midterm. Now, I don't think there's an opportunity ASAP, but there will be an opportunity in the bond market, and I will tell you how I'm playing that. Also, we will go over a little bit of statistics regarding how the market performs after midterm elections, since the midterms are coming up. And if you guys are looking at this dope ass hoodie, this Champion Traveling Trader collaboration hoodie, they are now in limited stock on the travelingtrader.com. If you're watching this video, depending on when you're watching it, but from the date that it drops, these will be up for 7 days. So make sure to go and get one just in time for hoodie season if you are so inclined. They're super comfortable. So how did the Fed screw the bond market and what that means for stocks? Let's get right into it. So even though we covered it on our live stream, shout out to everybody that was on the live stream, I'm going to play you what Jerome Powell actually said. If you guys were tracking this, you saw that the markets actually turned green when Jerome Powell started speaking because it sounded like he was going to be vague. He was talking about the lagging effects of the rate hikes, meaning that it actually takes time for the rate hikes to reflect in the actual economy. He was talking about the cumulative effect of the rate hikes, meaning that all of the rate hikes the Fed did up until now, there was going to be a compounding effect once they actually hit the economy. So it sounded like he was going to actually talk about potentially softening in December and beyond. Give us a clue as to what the terminal rate will be. Again, the terminal rate means the rate at which the Fed will stop hiking and assess what's going on and potentially pivot from there. And he started off saying that, but there's a moment in this meeting at which things took a turn and his tone shifted vehemently to the opposite direction. So let's take a listen and I'll show you what I'm talking about. And then we'll take a look at the markets.
Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation.
So as you see there, he said we will recognize the cumulative effect of the rate hikes and we realize the lagging effect of the rate hikes. So it sounded like up until this point that we were likely going to get some sort of slowdown in December or beyond, or at least a clue as to when they are looking to slow.
So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last 2 press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made.
So the market still loved it up until this point.
It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
So yeah, and then he goes on to say that there is no risk of over tightening, and the risk is actually loosening too early. So as you see there, that is where things took a turn and the market actually started tanking, is because he said that over tightening, he doesn't even think that we've hit a point at which over tightening is a thing, meaning that the rate increases so far have been justified. More increases are to come. There is no reason to slow down. There are no economic indicators or economic data, whether it's unemployment, CPI, PCE, that showcase a need for the Fed to slow down. And we have a lot of ground left to cover. So he left the question of the terminal rate open-ended. Again, the terminal rate is the rate at which the Fed is actually going to stop hiking and assess what's going on from there. And what that did to the bond market, if you take a look at the 2-year, and there's a misconception, by the way, that the 10-year yield is the one that is most sensitive to rate hikes. No, the 10-year yield is the one that we reference for a couple of things. One, mortgage rates as well as interest rates throughout the consumer economic system. And also the 10-year is used to in a discounted cash flow model when we are evaluating companies using a DCF method or a discounted cash flow method. The 10-year is considered the risk-free rate. However, the 2-year is the one that is most sensitive to bond rate hikes. To Fed rate hikes. And we saw the 2-year go above 5.1%. We haven't seen these types of levels since 2007. And you can see the rate at which the 2-year increased. This is just from last year to this year. We went from, basically 0% to 5.1%. Now, the reason that this happens is because bond investors don't have an expectation on how long the Fed is going to hike, where the terminal rate is going to be, how aggressive they're going to be, when they're going to stop hiking. So bond investors essentially want to get as much yield for their money as possible, especially if they are taking risks. If treasuries are considered risk-off assets, however, there is no determination as to how bad inflation is going to get, when it's going to slow, how bad a recession is going to get, and when the Fed is actually going to stop tightening. If there are no indications for any of this stuff, then bond investors are likely going to hold their cash, because even a risk-off asset like a treasury, the yield, they're going to require more yield to take that risk of all of these other things in the economy, the inflation, recession, rate hikes, for all of these things to finally normalize. So because there was a lack of liquidity in the treasury markets, and you could see here that the 20-plus year treasury bonds have actually dropped more than the S&P 500 this year. So this signals even more of a liquidity issue. But because of this, I thought the Fed would, obviously, as we said time and time again, the Fed is going to do a 75 basis point rate hike, and they did. But I thought that they would likely be a little bit more lenient on the language, considering future rate hikes, the terminal rate, how long they expect to hike, when they expect to stop hiking, and assess whether they're going to slow down in December. And it sounded like Powell was starting to say that, as you saw from the early part of the testimony. And then once he started getting questions, he went really aggressive with the messaging that we haven't over-tightened at all. What are you guys talking about? Have you looked at the economy? The jobs market continues to be super hot, and the labor market is really tight at the moment. CPI isn't coming down. PCE isn't coming down. Now, we did get an unemployment number today, and it shows that unemployment is finally a little bit up. It ticks up to 3.7%. This was after unemployment came in lower last time and hit a low of 3.5%. We are now back at 3.7%, the same unemployment rate that we saw in August. And what the Fed is hoping for, and they've actually stated this out loud, is they want unemployment to go up, because that is one of the ways in which inflation will come down when less people are able to spend money in the economy. They want unemployment to go up. And as you can see from all previous recessions, which are highlighted here in gray, we typically hit a recession after unemployment starts ticking up, not peaks. Usually unemployment peaks after a recession, as you see here back in the early 90s, as you see here back after the dot-com bubble, as you see here back in 2008. The recession is over before unemployment peaks. And I've talked about this before, but don't expect all of these negative economic indicators to bottom before the stock market starts rallying. This is where I think newbie investors make a mistake, is they're like, we're going to wait for earnings to bottom out. We're going to wait for payrolls to bottom out. We're going to wait for unemployment to hit a peak. We're going to wait for GDP to start crawling back up before we invest in stocks. But looking at every single recession in the past, the dotted line here is the S&P 500. You could see that the S&P 500 starts a major bull rally well before all of these things actually peak, well before all of these things actually peak or bottom out. So this is going to be no different here. And I sent this out in the Academy, stats on what happens after the midterms. We'll go over this in a second. And by the way, if you're not part of the Academy, we send out live trades on stocks, options, futures, short-term day trades, long-term holds. My complete analysis on the stock market, as you could see here. Access to the Zoom calls with me that we do twice a month, where you can literally ask me any question live regarding trading, technical analysis, options, futures. You get access to the day trading course. You get access to the options course. We obviously day traded FOMC live. We shorted the market during FOMC using futures. And I even took this trade live if you go back and look at our live stream. But if you want access to that, link is in the description below. We just opened up spots for November. Here is what happens. Let me see if I can make this bigger. Here's what happens during the midterms. This is extremely interesting. So every single midterm going back to the 60s, regardless of whether the president is a Democrat or a Republican, regardless of whether the seats flip blue or flip red, it does not matter. It does, this does not fail. 6 months after every single midterm election, the market is green, and the market is super green 12 months after every midterm election. Now, if I think about this and try to coincide it with the Fed's actions, say 2023, we start getting a drop in the CPI, right? Because inflation is not going to be around here forever, and the Fed is acting aggressively, and they are going to fix inflation at the rate that they're going. What needs to happen is that the actual CPI needs to be below the Fed funds rate. So the CPI is going to come down from 8% down, and the Fed funds rate is pushing up. And what the goal of the Fed is that the Fed funds rate is actually above CPI, above inflation. That is their goal. And so if they push to a 5 or a 6% Fed funds rate, and that is their terminal rate, well, you have to expect that inflation is going to come down from 8% to 7 to 6 to 5 at some point, because you can't have this tightening of monetary policy without there being an increase in unemployment, a decrease in inflation, a decrease in the money supply, a decrease in spending. We are already seeing that in the housing market because rates are just so high. The housing market demand has completely come to a halt in a lot of markets in the US. So if we take that into account, yes, I can easily see 12 months from the midterms on Tuesday how the market is going to be higher than it is today, especially when you take into account this effect that the stock market is forward-looking and it will start rallying as the economic indicators start looking better, and they don't actually have to bottom out before the market starts rallying. As a matter of fact, in a recession, they never bottom out before the market starts rallying. However, I do think we will eventually, at some point, it doesn't mean it's going to be a straight line up or down. I think we will get to the pre-COVID highs at some point because of earnings compression. I think that all of the earnings that we saw during COVID will eventually be addressed by the market. That imbalance will be addressed, and we will eventually get at least to the pre-COVID highs here on the indices. But at some point, CPI is going to come down. It is already peaking. It's just how bad the recession is going to get once we finally hit one, and how bad unemployment is going to get once this finally starts ticking up, and how bad earnings are going to get once they finally start experiencing true demand destruction from the high unemployment rate. We don't really know the extent of that, and the Fed doesn't either, because right now they are really pushing the gas pedal on these rate hikes without assessing how the lagging effect is going to play out in the economy. But the good news is, at least on the treasuries front, we are seeing 2 days in a row of heavy bond buying of the 2-year treasury. And this is denoted by these huge liquidity wicks that you see here. Once the rate went to above 5%, I think bond investors couldn't pass that up. They're like, 5% for 2 years? Yes. Okay, we're going to take that as a risk-free investment. Now, remember that the elections are November 8th and the CPI is November 10th. It is possible that we actually get a somewhat favorable CPI this time around, as the price of a lot of commodities have dropped. So it's possible that this is the first time we get a CPI below 8% for the first time in so many months. And if that happens, then I think the market will actually find that as good news, and we will likely see a small rally towards the end of the year, especially with the midterm election effect and the midterms being over. And we are already seeing Fed members coming out and talking about the possibility for slower rate hikes ahead. So if the CPI number, because we did get a higher unemployment number this month than last month, so it looks like things are trending, albeit very slowly, in the right way. But if we do get a lower CPI number, lower than 8%, then I think the Fed in December will likely do a tepid rate hike and not another 75 basis point rate hike. We have 2 CPIs, by the way, before the next FOMC meeting. So the Fed does have quite a bit of time to assess whether we will do a 50, another aggressive one, or nothing at all. But I do think that the next 2 CPIs will play a huge part in what the Fed does in December. And at that point, I think we will likely see a bottom in the bond market, and we could start longing things like the 2-year note futures, which is denoted by the ticker symbol ZT. We could potentially start longing this stuff. TLT is another long that I talked about, when the bond market feels more secure about the Fed's future actions. Those bonds will actually start to rally, meaning the yields will drop, because remember, there's an inverse relationship between yields and bonds. Anyway, traders, that is it for this video. That is how the Fed pulled the rug from underneath the market and completely demolished any sort of short-term bond plays. I thought that they would come in and try to save the treasury market from illiquidity. They absolutely gave 0 Fs and didn't do that. However, I'm glad that we have the expertise that we have in the academy to be able to day trade this stuff, wake up neutral, and not really come in with any sort of predetermined notions as to what the market is going to do. We look at what the market is doing that day, take in all of that data, find optimal trades with high risk rewards and a low price of punishment if we're wrong. But that is my take on what the Fed did. We will look at the next 2 CPIs, see if they're trending in the right way. If they are trending in the right way, I do think that we eventually see a slowdown in the next December FOMC. Go get your hoodies just in time for hoodie season. Once they're out of stock, they will be out of stock for a while until we can restock them again. Sign up to the Academy. Link is in the description below. Signups just opened back up again for November. If you got anything out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think of the Fed's actions, whether they're going to slow in December or not, whether you think inflation is going to start coming down in the next CPI or not. Would love to hear from you. Stay safe out there, traders. Peace.